Hello and welcome to this week's episode of Nucleus Investment Insights. Today we're going to ask the question, is cost inflation beginning to bite? On the agenda, we'll discuss if the earnings boom will continue, as earnings have rocketed off the COVID lows, and question if this is sustainable. Next, we'll look in depth at Q1 earnings and explore whether companies are suffering from inflation or whether they're passing these costs on to consumers. Then we'll have a look at the economic slowdown and how this is tracking to date. We'll also analyse earnings in the US from the top down and then from different regions around the world. We'll also analyse some charts of different sectors as well. And then if we have time, we'll look at some individual stocks. And as always, we'll cover the investment implications at the end. And just an FYI for our viewers, you can download today's slides from our website at nucleuswealth.com/webinars. We generally put them up in the afternoon, so if you want to have a more in-depth look, feel free to download them at your leisure. So my name's Sam Kerr. I'm a Senior Financial Advisor at Nucleus Wealth, and today, as always, we'll be joined by the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hi, Sam.
Hey, Damo. So everybody may have noticed that today's webinar is a day later than usual.
Yes.
That's because, yes, Damien and his whole family have had COVID. So, Damo, thanks for soldiering on and just
six from six we're up to now. So we had our final holdout tested positive this morning. So yes, we're now got the full set. So
yeah. Well,
yes. Anyway, through the worst of it.
Yeah, we all hope you get better soon, and I hope for a speedy recovery.
Yeah. Yes. Absolutely.
And yeah, just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening in live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now that we've got that housekeeping out of the way, we'll get started. So, Damo, I'll hand it over to you.
Yeah, thanks. So wanted to run through the earnings season, and we posed this question, whether cost inflation is beginning to bite. Whether cost inflation is beginning to bite. Are we looking at companies where margins are starting to contract because margins are starting to contract because costs are rising and wages are rising and they can't pass it on to customers? And the answer is no. Still, the answer is no. Still, we're going to go more into the details. But before I do, I should start with a quick recap of how I tend to look at reporting season because there is so much information, so many different ways you can look at these, and companies are always trying to report things in the way they look best. So I just want to give you some big picture overviews because what you often see is this idea about whether companies have beat the forecast or not. And to me, that's a bit of a furphy. It's not something you really don't want to pay too much attention to on the numbers that get reported. Because what often happens is a company analysts will be forecasting $1.10 of earnings for a company, and the balance date rolls around, so it's 31st of March, and a few days later, the company's going through its numbers, and they're going, we're not going to make $1.10. It's going to be about 10% lower than that. And so they go out to the market. They haven't got the actual numbers yet. They haven't reported their numbers to the market, but they go out and they either talk analysts down or they put out an announcement that sort of says, if they'd previously given guidance, they'll bring it back down and go, we're end of the quarter and whatever's been a bit weak, and we think earnings will be somewhere between 95 cents and $1.05 or something like that. And analysts will come in and they'll change the numbers to be $1, as their forecast, and then 3 or 4 weeks later, the company will come out with its actual audited results, and let's say at that point it comes in at like $1.02, and then everyone goes, oh, it's a beat. The analysts were expecting $1, it came in with $1.02. It's beat forecast. And it's like, well, yeah, but only because the company downgraded 3 weeks ago, when they'd had a look at their earnings, and so. So there's this sort of consistent issue about what numbers are you really looking at. So and then you have all these different types of adjustments to go into it. So you get companies that they sort of start talking about their numbers, and excluding a whole bunch of different costs, usually costs, sometimes revenues, but most likely it's excluding a bunch of costs that are sort of one-off in nature, or the company is deemed to be not worth including in the comparisons. And so so we have sort of a couple of different ways we look at it. One is we look at a sort of what we think the beats are for about a month prior to the actual result, and seeing what how that comes out. And the other thing is we look a lot more at forecasts. What a forecast do post the result? Because there's one thing just for a company to come in and say, we beat earnings forecast by 15%, and and margins are up and everything's fantastic, and then you look at the company and go, oh, that looks great, that must be a hugely positive result. And then the next thing you see is the stock's fallen 5 or 10% because everyone's downgraded their forecasts. And so a lot of that is because once you dig into the numbers and look at all the exclusions they've done and really go forward, that's where you get a better picture of was this a good result or not a good result. So with that in mind, I just wanted to sort of give you a longer term view as well. And I'm using a lot of the S&P 500 numbers here just because it is a big index. You get a lot of quarterly data. So Australia, you don't get the quarterly reporting. Europe, it's a lot more mixed as well as to whether you get quarterly reporting and to what level. But in terms of the companies we're looking at, the large cap companies in the US, are a good place to start. And you can see on this chart I'm showing there, it's a net earnings revision. So it's basically how many upgrades are we seeing versus downgrades to forward earnings. And we've just been through this huge blue patch over the last 2 years, which is pretty much unprecedented in terms of the size, over the last sort of 30 or 40 years it's shown on this chart. So, there's some pretty strong upgrades post the financial crisis in 2009. You had some good, strong upgrades post once the tech boom had all finished and crashed. So sort of the mid 2000s, sort of 2003, 2004. But really, it's the size and the scale of this latest batch of upgrades has been pretty unprecedented. And it's still positive, but it's obviously come down a long way from how positive it was 6 or 12 months ago. So, and I think that's largely the tale. Oh, sorry, actually, one other big picture thing I wanted to get to with these forecasts as well is, particularly first year forecasts, what we're talking really, while they're coming from analysts, I think of them largely as company forecasts. Because companies, and particularly big companies, have the investor relations departments. They speak with analysts. They'll talk about the numbers. If they see analyst numbers that are way out of whack, they'll call the analyst up and talk to them and work out why the numbers are so much higher than everyone else, or what they're doing, and just make gentle suggestions if the analysts might have things wrong about where they might have them wrong. And same, not just too high, too low. That's their job to keep the market fully informed, and so a lot of that sort of revolves around getting that back. And so the analysts really, it's more about a flavor than than sort of the picking the actual food type, if you know what I mean. Like, so a company will come out and say, we're expecting earnings to be up somewhere between 10 and 12%. Over the next quarter or over the next year or whatever, and so some analysts will come out and go, I'm really bullish on this. I think the company says 10 to 12, and I'm going to say 14, and then someone else goes, oh no, I'm really bearish. I'm going to say it's 8%, and what happens is usually the margin of error between the most optimistic analyst and the least optimistic, or a reasonable range of those analysts, like, they're in quite a small distribution, and then when you look at the actual range of distribution, it's like 3 or 4 times bigger than that. So the amount of confidence, so to speak, you see in analyst forecasts is way higher than what it actually comes out to be. So earnings are a lot more volatile than what you get, and a lot of that is because those earnings are pretty much coming from the companies. And so that's one part, which is not a problem usually. In normal times, that's the best guide we have. What happens though is when you go through large sort of macroeconomic distortions, that's where companies tend to be some of the last ones to know what's going on. So when you're running into the financial crisis, or when you're hitting pandemics and things like that, if you've got, you'll often find analysts will just, or companies will just freeze, and analysts will just freeze. So pandemic hits, earnings falling, companies don't know what numbers are going to do. They've got literally no idea whether they're recovering or not recovering, and so they'll just say, "Oh, we're ceasing our guidance." And analysts sit there and some of them downgrade and some of them leave the numbers, and a lot of people just hope the problem's going to go away. And so often there's a fair lag in terms of before you actually start seeing the genuine downgrades, and that's where some of the macroeconomic outlooks, and hopefully that's where where we add some value in terms of these is actually that part about looking forward. And the question for me is, are we reaching one of those phases now where we've seen a record speed of interest rate rises and around the world? We're seeing more supply chain problems, lockdowns in China, all these other things going on that are sort of pointing towards a negative outcome. Hasn't yet hit the earnings, and very clearly, I want to be upfront and say, we're quite negative on a number of things in the markets, but that's not being reflected in earnings yet. All in all, you'd sort of say this reporting season's been relatively good, but the question is, is that coming? So I'll give you an indication as well. I've got another slide here, which is just showing how earnings revisions typically come about over the year. So if you look at the second year, I'll take the chart on the right first because it's a little bit more extreme and shows probably a better indication of what analyst forecasts do. Is that typically what you do is if you started with analyst forecasts in at a point in time and it was 100, and then you looked at how that changed over time, on average, you'd find that forecast of 100 would downgrade by about 5% over this period sort of shown. So just sort of there's optimism built into forecasts, and so gradually over time you'd expect that to just keep declining. And if you included everything, you'd sort of get more like 10% downgrade. But if you exclude the sort of COVID and financial crisis, then it's more like about a 5 or 6% downgrade you'd get on average. And that's just this natural optimism that analysts sort of have over numbers, and especially later numbers. And we'll get into that in a minute. But what we've seen so far since for the first few months of this year is actually the opposite happening. So we've actually seen a pretty solid upgrades, and so that's a sign that companies are managing to keep that profitability, certainly so far, and that the sort of the quite extreme profit growth we've seen over the last few years certainly hasn't gone away yet. So I guess it's still a very strong some very strong results.
And Damien, what's really driven all the sort of earnings growth and the profitability since the sort of COVID lows?
Okay, so since let me go back first to go the last 3 or 4 months. Most of it is energy stocks, so that's been the vast bulk of this rise. So obviously we saw oil prices and gas prices and coal prices have all rocketed as Russia invaded the Ukraine, and that sort of then led to much higher earnings expectations for all those companies, and also extended higher profits because people aren't expecting these problems to go away quickly. Since the COVID lows, a lot of it's just been the amount of stimulus and the amount of government money that sort of got pumped into the economy was one big measure. There's a reasonable amount of productivity gains companies had, and then actually that'd be the two main ones. The sort of companies were forced to make changes, and so that sort of led to some productivity gains, and then the other side, the amount of government stimulus, sort of all this extra money sloshing around, ended up in the arms of companies. So then we get to I've got another one where I look at companies, look at just quarter by quarter earnings in the US, and in this one, so this is sort of an idea about as the quarters sort of go on, as you sort of progress from one quarter to the next, how do earnings change? And so we can see that there's a blue line right at the bottom, which is the quarter one earnings, and they sort of rose quite sharply, right? So this is the expectation for how much companies were going to earn in quarter one of 2022. And so that rose quite sharply right throughout 2021 as analysts sort of upgraded their numbers. At the start of the year, it's actually started to fade. So that sort of tailed off, and there were downgrades happening. And then as the reporting season action happened, that's rocketed it up. So we've seen a significant rise into that. So that's for the large cap stocks. On the right is the small cap stocks, and it's not the same for the small cap stocks, I guess, is the message. Having said that, though, that's Q1. There are some distortions almost always in terms of these numbers and trying to work out what are real numbers and what's not, and what was unexpected and what was, what's a true underlying recurring number is always difficult. Looking at these later forecasts, there still is this sort of a gentle upward slope to all these lines, which is a positive. When you're seeing that those numbers are rising, that's sort of more support for earnings, and it's not sort of what you'd typically see. So, and then if I put that into sort of a longer term picture, I mean, this is sort of why you buy the stock market, why you buy stocks in the first place, is we've got this blue line, which is the forward earnings for companies. So how much we're expecting companies to earn over the following 12 months. And that's sort of every day sort of updates with one more day of next year and one fewer day of this year. And just sort of rolls throughout time. So you can see sort of post-COVID there, that blue line has basically been as steep as it's ever been. It's just, it has just been rocketing higher. And then the most recent time, it's still headed higher, and encouragingly, both sort of 2022 and 2023 have seen the upgrades. Once we dig a little bit more into that, we'll see a lot of that is energy, but certainly it's not. It's certainly not a negative picture on other sectors. It's just a very positive picture on. It's more like a neutral picture on most other sectors. But anyway, we'll get into that as we go. The other one I wanted to show was just same numbers presented slightly differently as growth rates. So if you want to look at the growth in earnings, I've got this. I guess rule of thumb that I use, which is basically that analyst growth or company growth, as I spoke about, growth forecasts basically start at 10% in every year, and then they go one way or the other, and it's sort of like that idea that if you're not quite sure what the company's going to earn, let's call it 10%, and then when things get closer, if it's looking like going to be 10%, if it's going to be more than 10%, then you start upgrading, and less than 10%, then you start downgrading. And that's largely, if you look at this line, that's largely what you see, right throughout that period back in 2012, 2013, 2014, 15, 16. All the analyst forecasts started at around about 10% growth. And then as time went on, they just gradually went down. Then every now and again, you get a year like 2018 when you get these massive tax cuts, and earnings all of a sudden take this huge jump up from the tax cuts. But again, that's 2019, 2020. You can just sort of see that those earnings start at 10% and then go from there. And that's basically where we are for 2022. Earnings are still at 10%, and 2023 haven't moved. So it does. I mean, absent anything happening, which I do think we're in for a slowdown in the second half. But absent anything happening. Absent that, I would have thought that 2022 was 10% was probably reasonable. We're far enough in to know that it's probably going to be close. It's looking right now looking like being close to 10%. The 2023 numbers, I don't take any real any real heart in that forecast being 10%. That's just a typical forecast at this far out, if that makes sense. So that's sort of the big picture overview. If we break into some of the sectors and some of the countries, so firstly, on a country basis, largely the same, regardless of how you look at it. There haven't really been upgrades to 2022 or 2023 for the median companies. So, this is another problem you have with all these numbers. Are we talking about averages? Are we talking about medians? Most of the charts have just been showing before about averages, so that they're affected by what's happening with large companies. Then if we look back at the sort of median company and say what's happening, what's happening for the middle of the distribution. So then we're basically looking at no change to forecasts. So some companies upgrading, some downgrading, but that's actually not a bad result. That's less typical than what you might expect. Like the typically would actually see more downgrades than upgrades. And then the other thing then is in terms of sector earnings. If we look at the sector earnings, you get a very different story here. So you can certainly see within sector earnings that almost all of it's coming from, well, certainly in terms of the upgrades, almost all of it's coming from the energy sector, a little bit from the material sector, and most other sectors are neutral in terms of how they're looking.
And is this sustainable, Damien, do you think, if it's all coming from energy, or is that going to sort of peter out?
No, I don't think it is sustainable. I think there's actually, let me start a little bit around that. No, actually, let me keep going with the analysis first of what's happening at the moment, and then let's get into where we think it's going forward. Because I think from the analysis, certainly at the moment, is you'd say absent any macroeconomic outlook, the view from companies at the moment is still, as at this reporting season, is still relatively good. There's not a lot of upgrade, not a lot of downgrades. Yes, there hasn't been a lot of upgrades, but given the natural bias to downgrades, that's a good thing. And the fact it's quite broad based is relatively positive as well. One of the things to note, I guess, in terms of looking at, say, I've got another chart here that's looking at the earnings estimates for Q2. So just sort of starting to look at where we have seen upgrades and downgrades, which sectors. So as we spoke, energy and materials are the biggest ones. Industrials and utilities have actually seen some upgrades, but most other sectors have seen downgrades, and particularly some of the commercial services down quite heavily, and some of the discretionary sectors are also down. Margins. So in terms of that was just in terms of keeping an eye on that. I spoke before about the effect of inflation. We're seeing that yet, and the answer is quite clearly no. We're still at these record margins. So this is I've got the S&P 500 quarterly operating margin there. So you can see it's sort of rising from 6 or 7% up to 13% over the last 30 years. So and pretty steady upward trend to that margin. So it looks very impressive, that line. It is worth keeping in mind that there's changing composition issues within that. So, and what I mean by that is companies with lower margins tend to be ones that had back sort of in the 90s, for example, you tend to have a lot more manufacturing companies or even sort of big retailers in there where they were actually turning over so the sales was quite high and the profit for every sale was quite low, which is very different to your Apples and your Facebooks and your Googles and your Microsofts, who make these massive margins from for every dollar of sales. Often they can get 30-40% of it come through as profits. And so and we've also had lots of tax cuts over that time frame as well. So the average tax rate has gone down quite substantially over that time period. So while this sort of line looks like this steady upward march, and it's often hard to explain, well, why is this, why are margins going to keep rising, ad infinitum? There is the structural changes and the issues with different sectors within that. And then the other one is, in terms of those margins, is that, what was the other one? Oh, there's the outsourcing part as well, is that, if you have a product where, so something like a Boeing, for example, used to make a lot of the things in-house. It would actually have, it would hire the staff it would create the products and sort of be fully integrated into the whole process. Whereas once they start outsourcing it, or even things like where you might sell your land and lease, often that can improve the margins, the operating margins that you've got, and as you sort of sell your assets and lease your assets, so it sort of brings down some of your costs. So it depends upon how the whole trend to both more services, the rise of the IT companies, and then more and more outsourcing is sort of all leads to that higher operating margins, which is why when we're trying to assess companies, we tend to look at it relative to their own group, rather than worrying about this line about how high it can go. That makes sense. Okay, that was sector earnings. Sorry, was there a question I skipped over, Sam?
There was a question back at the start. It's a little bit unrelated about fertilizer shortages. Do you want to address that now, or address that maybe at the end?
No, I'll hit that after I've hit this next couple of slides. Yeah. Okay. Okay, so the next thought then is this whole, what's going forward, and what are the issues which could potentially drag on earnings? Because this is the part where our companies sort of a company's walking into this going, okay, our best guess is that everything looks fine, but we haven't factored in the fact that that China's locked down half its country well, not half its country, sorry, that's overstating it, but locking down a number of major areas, particularly a number of major export areas, and are going through. It looks like they're pretty set on keeping that policy, probably for the rest of the year, maybe into next year as well. There's so that's going to be affecting things. We're looking at much higher interest rates in a very short period of time, is affecting things. I've got a chart up here showing the corporate sentiment index, and that's a survey that gets done, and then you look at so it's a survey of customers, survey of corporates, and then you look 1 quarter later at what actually happened to the earnings, and there's a pretty good correlation between those two lines, and we've just sort of recorded one of the most negative corporate sentiment corporate sentiment readings that we've ever seen, sort of on par with 2008, 2009 lows, and similar, and maybe not as deep as 2020, but yeah, quite substantially quite a substantially negative reading, which would indicate that earnings are about to take a hit. We've obviously got some more supply chain problems, much higher energy costs, weighing on demand. But the biggest one for me is the idea that we've basically got the central banks around saying that they want to bring inflation back under control, and we have this supply side problem, and so effectively what they're suggesting is they're going to cause a recession in order to bring demand down to a level that sort of matches the supply, or certainly if it's not a recession, it'll be something very close to one. And so that's the real issue. Is that something which hits in the next quarter? It's hard to tell. Certainly over the next year, I think these factors are some of the key ones we need to look at in terms of what's going to come out. But I guess this idea is that there's so the overall summary, I guess, is that corporate earnings still look pretty good, but are we about to walk into a considerable downgrade? And our answer is quite possibly. Is it coming in the next quarter? I'd put better than even odds, but it's certainly nowhere near 100%. By the time you get to the third quarter numbers, it's based on how we're seeing things at the moment, we're thinking it's quite likely you'll be seeing earnings coming off quite strongly by the third quarter and certainly into the end of the year. Right. So does that make so with that, I'll jump to that question on fertilizers. Is it?
Yeah, so it's a question from Craig Don. He's just asking, are you able to comment on the extent of fertilizer shortages and price rises in Australia and the implications for food production?
Yeah, sure. So, yes, look, it's a big issue. I think that the thing to remember with the fertilizer, there's a couple of things with the fertilizer. Okay, so one is fertilizer is very it's very leveraged to the gas prices, and gas prices don't look like they're going anywhere. So gas prices look like they're going to stay high for a considerable period of time, and which means the number of European companies, gas producing companies, a number of European fertilizer companies who have to use very expensive European gas are just looking at suspending operations. And so, and that then flows on to food production, which then could cause problems. So, so that then means inflation is probably going to stay relatively high in the food part, absent of fall in demand. So that's going to be one more reason for, I guess, if central banks genuinely want to bring down food demand, they need to create enough unemployment or enough pain, economic pain around the world in order to do so. The food problems tend not to hit rich countries very hard at all. So if you're talking about, say, a loaf of bread, I feel like the cost was somewhere between 15 and 30 cents. I think it was closer to 15 cents, say, for the cost of the wheat within your loaf of bread. So you're really not talking about a big rise in terms of if it doubled or tripled. You're talking about quite a small change in the overall cost of your price of bread. Similarly, if you're talking about coffee, like I've seen a few things recently about people talking about, coffee prices are going to have to go to cup for it because of coffee prices rising, and that's complete nonsense. They might go to $6, $7, $8. I'm not saying that won't happen, but I'm saying it's not because of coffee prices. Coffee prices in terms of you buy your $4 cappuccino or latte or whatever, 15, 20 cents of that's the coffee. If that doubles or triples, again, it's hardly any difference. But what most of the cost is it's the machine, it's the milk, it's the rent, it's the price of the barista who's doing it. And if those are all going up, then maybe your coffee price needs to rise. But in developed countries, the actual food cost as a percentage of the final product is actually surprisingly low relative to all the other costs that are going into it. So the fertilizer side, so sort of following that logic, fertilizer prices are up quite substantially. Farms aren't using as much fertilizer, so aren't producing as much crop. Therefore, there's more food shortages, which means the food becomes more expensive. But developed countries doesn't really make that much difference. Where it really hits is developing countries, and what it tends to do really is cause a lot of geopolitical issues when that happens. And so that's the real sort of danger going forward is, the last time we had a lot of food shortages and inflation was when the Arab Spring sort of happened and revolutions in Libya and other places sort of that were sparked off by the in part at least by food prices. So, I guess the danger is we get another round of instability in a lot of countries. Comes from that. From an earnings perspective, it's a sort of it's a sad part that developed countries really doesn't make that much difference. But absolutely from a human perspective and the number of people affected, it will certainly affect a lot of people, but mostly in poorer countries. Is that anything else there, Sam?
We're a little bit light on viewer questions today, but that's really insightful. Thanks. So we'll just put out the last call for any final viewer questions before we get into the investment implications. So just drop them in the chat below. We can answer them after this segment if there's any more questions. But now we've got our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. And there's been some really good interactive chats coming through as well. So the question is, will the earnings boom last? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damien, I'll pass it back to you for the investment implications.
Yeah. So look, we've spoken a few times about this, and I just want to put it back out there because it's the number one sort of stuff I've probably been saying for a year and a half or 2 years now, is that markets are supported by central banks and government stimulus, and the number one risk we all face is policy error. It looks with every passing day, it looks like we're reaching this policy error. There is in terms of the rise in yields that we've seen, we've sort of ran a podcast last week. We think it's now hit the stage where it's time to start taking the other side of that, and we're starting to sort of work our way into that trade. There's the US dollar keeps rising, which is actually sort of making the problem worse for emerging countries. Actually, I didn't show emerging markets on this slide, mainly because we deal in large cap stocks globally is our sort of focus, but if I showed those same charts for emerging markets, they look way worse. So emerging markets, the profits have already started falling, and the stronger you see this US dollar, the more danger we see for emerging markets. And emerging markets also coppered a lot worse from higher energy prices. So we're expecting a relatively quick reversal in terms of inflation. Whether it's over a year or 2 years, but we're certainly not expecting inflation to stay high at a particular level because of demand. We think it all comes down to supply, and we think that in a world where it's been hard to find demand, trying to snuff demand out at this point of the cycle is going to be really dangerous. And we're quite nervous about the prospect for stocks. And so obviously a big negative night overnight for the US and back into Australia as well. I guess if we're right, this is sort of we're still in the early stages of this pullback, and so excuse me. It's not time to start taking the other side of it just yet. On that base, and so at some stage we are expecting that Australian the bond yields, the stocks will capitulate further. Bond yields will hit the stage where they decide that actually the earnings downturn is happening, and so we'll at that point we'll sort of be switching out of the bonds and back into stocks, but we're not there yet, and could be some time.
Okay, that's great. I'm just looking through the questions here. We've got one more question that's just come through. So if your base case is a few years of higher rates and inflation, then is it going to be deflation or stagflation? Sorry, go ahead. Yep.
Yeah, deflation. Look, we might post that period, you might go back into a period of stagflation. I think there's deflations are most likely in terms of we're still of the view that most of the inflation we've seen is coming from supply issues. There has been a lot done on a lot of these supply chains, and a lot of the products that are sort of being sold at much higher prices. And I think partly looking at how high profits are managing to stay is that sort of reflects it. Is there's a lot of products out there, people are more than willing to sell it at yesterday's prices. It's just that there isn't enough out there because of either shutdowns or supply chains or supply chain problems or people quarantined and haven't been able to work, and so that's what's keeping prices high. As that starts to fade, we're expecting that will sort of slingshot back in the other direction, and so deflation. Question after that is, do you head into a period of deflation, and then as the economies recover, do you then go back into a period of inflation because supply chains are starting to fracture because of people moving out of China and a number of other places? There's certainly a few issues around there. There's lots of issues with energy at the moment, and I think there's we're going to see a much more rapid shift now to renewables than what we're expecting, which is great for energy inflation in the medium term and the long term. We'll actually see energy stop being a volatile part of the the whole inflation package and actually become very stable, because it'll be based on much more on solar power and batteries, and so you'll probably see that coming down over time. So that's positive. But in the short term, until we get there, there's going to be some quite volatile spikes and in energy, as we don't see a lot of investment on that oil or gas side at the moment, and then supply just sort of bounces up and down, trying to meet that point.
Nice one, Damo. Yeah, that sums it up nicely. We haven't had any other questions come through, so that almost wraps us up. So, Damien, just want to thank you for your time, your knowledge, your insights, as always.
Thanks, Sam.
Great. And we do welcome your feedback on this podcast, especially in relation to future topics. So if you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial situation, please go to our website at nucleuswealth.com and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can follow us on all social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.